In the financial world, seismic shifts don't happen every day, but when they do, they ripple across the globe. One such tremor is the recent deal between Capital One and Discover, a $35 billion all-stock transaction that has the potential to redefine the landscape of credit card companies. This tale commences on a usual business day when Capital One announced its intention to acquire Discover Financial Services, a move that, if successful, will fuse two major credit card companies into a single entity. The motivation? Capitalize on the increasing use of credit cards by Americans, despite a backdrop of rising interest rates and borrower defaults. However, acquisitions of this magnitude are not without their complexities. The deal is set to provide Capital One access to Discover's payment processing network, a feature that has faced its fair share of regulatory challenges. Moreover, the transaction's approval hangs in the balance, with consumer groups already rallying to scrutinize its impact on consumers and competition in the market. This acquisition comes at a time when consumers are grappling with inflated prices and escalating credit card debt. A recent report by the Federal Reserve Bank of New York revealed that by the end of 2023, Americans held over $1 trillion in credit card debt, a staggering increase from the $930 billion held at the end of 2019. The same report also highlighted an unsettling trend. Borrowers are having trouble repaying their debt. Serious delinquencies among credit card borrowers rose over 6% in the fourth quarter of 2023. The markets, ever watchful, responded swiftly to the news. Discover's stock rose, while Capital One shares experienced a slight dip. Capital One expects the deal to be finalized by the end of 2024 or early 2025, assuming federal regulators give the green light. So, what does this deal imply for the future? Well, it paves the way for Capital One to become the nation's largest credit card issuer, outpacing even JP Morgan Chase and Citigroup. The acquisition of Discover's global payment network will allow Capital One to deal more directly with merchants, thereby increasing its revenue potential. Moreover, owning a payment network will position Capital One to compete more fiercely with its main competitor, American Express, and reduce its reliance on Visa and MasterCard, the two dominant players in global payments. In addition, the deal could accelerate Capital One's banking business by tapping into Discover's network for banks. Far from being just a credit card merger, this acquisition could also boost Capital One's expansion into the banking sector. In summary, the Capital One and Discover deal is a game-changing transaction with far-reaching implications for the credit card industry. From the announcement of the deal, through the regulatory hurdles, to the potential impacts, this acquisition could redefine the financial landscape. It symbolizes a strategic move to capitalize on the increasing use of credit cards despite rising interest rates and borrower defaults. Furthermore, it could position Capital One as a formidable competitor in the credit card market, while enabling it to expand further into the banking sector. Only time will tell how this plays out, but one thing is certain: the financial world is watching closely.